You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to watching the Financial Survival Network. Well, these are dangerous times in global markets, stock markets, currency, bond markets, and commodities for sure. And the question is, can you make money even in a market like this? Chance Finucane is with us. And Chance, hey, you've got the Oxbow Principles, a global value investment firm based in Chicago, and you've been doing this a while. What do you do in a market like now where everything seems to be going down? Bonds, stocks, commodities, everything's going down. Everything was going up. How do you just go to the sidelines, raise cash, and wait for things to turn around, or can you play this on the downside?
I imagine if you were a long short fund or didn't mind going net short in your portfolio, you could try to play it to the downside. But for us, during a period like this entire year has been, our focus is much more on preservation of capital. We don't mind increasing our liquidity. We've actually got close to 50% in cash and treasury, short-term treasuries to generate some yield for our clients and their portfolios, just because we don't see a lot of opportunity out there. And we think it's going to take longer for this long-term bear market to play out before we're ready to start being more aggressive again.
All right. So when did you go into cash?
We always keep a little bit of liquidity, but we really boosted the cash levels in the first quarter this year, especially in late March when you had a bit of a short-term rally there. We also boosted it further towards the end of April. And really since then, I've kind of stayed at that trajectory where we've been about 50% cash. And try to keep everything else we're invested in to be very high quality businesses or investment grade securities that we could own that generate some income for our clients.
All right. So when do you think you'll be hopping back into the market?
At this rate, it may not be until sometime next year. There's always the possibility of a real capitulation on the part of investors that maybe you get an opportunity in the fourth quarter of this year. But based off our analysis of past long-term bear markets like the one we're in today, it seems like you've got a ways further to go. You need both a real selling off by investors to bring down valuation multiples even further than they've already compressed. And you're also going to need to see earnings expectations come down. And historically, that's usually probably not until new fiscal year guidance is given by company management teams in the January and February reporting period.
All right. So I guess the question is, Wall Street always tells us you can't time the market and that you need to be in it to win it and all of that good stuff. And really what you're saying, basically, it's not true.
I think it depends on where you are in your life, your amount of income you have coming in through other sources. I think if you're younger and you still have many years or decades left in your career, continually adding money into a 401k or IRA and just holding for decades until retirement, that's a great strategy. We primarily invest on behalf of former business owners after they've sold their companies. They don't have that steady income coming through like they used to when they're running their businesses. And in that scenario, a 50% decline in the equity market can be real damaging to how they want to be able to live out the rest of their lives. And so we really try to manage that downside so that if you have a 30% decline or worse, our balanced portfolios might only come down by 10, 15, 20% max. So that then it's a lot easier to get back up to break even when things do turn.
So when you're hedging, when you're not going full barrel, when the market's going up, your returns aren't as high either, are they?
No, they're not. And I think that's a conscious decision on our part when we just know, and we'll communicate that to everyone, that based off what we're seeing in valuations when they got really high in 2021 and early part of this year, or just what we're seeing in the economy, if we're starting to see some deterioration in economic growth, examples like that will lead us to want to become a bit more conservative in our allocation. and we'll end up just communicating that to everyone and tell them we want to wait for a better pitch to be able to really take advantage of an opportunity.
Okay, so you're talking a kind of a risk managed, risk adjusted portfolio. If and when this market does turn around, what sectors do you think are going to be most attractive?
Well, typically when you have a bottom in the market for stocks, some of the early cycle areas you might see start going up first would be consumer discretionary names like retailers. I think you could see the semiconductor market turn around pretty quickly, since investors in that sector usually start bidding those shares up before the bottom in the earnings cycle for semiconductor businesses. So you can see some there in those two sectors. But I think it's also going to be worth considering that if we do see a turn going back higher, you might see an increase back to more of an inflationary period accelerating rather than inflation starting to decelerate here. And it will pay to have some investment in commodities related stocks over that period.
All right. So you think that, are you making that call that inflation is not over, that we're going to see further bouts or rounds of it or waves of it?
We think that inflation peaked in June when it got over 9% in the US. And now you're probably going to see an inflation number at around 8% when they report it later this week. But I think what we're expecting is that inflation is going to decelerate, but it's not going to decelerate back to that 2% level that the Federal Reserve would love to see it hit as soon as possible. With core services inflation increasing and still seeing some inflation on energy and food, we actually think it'll probably stay more in that mid-single digit area for longer than you would expect. But from our perspective, if the Fed decided to reverse course and start easing again, that's just going to perpetuate this more inflationary environment. And it would help in that scenario to want to own some energy and materials businesses.
Okay, so energy is looking pretty good. We've seen just everything get hit, though. Energy was oil over $100, nat gas pushing $10 MCF. And do you think we're just getting a temporary reprieve, perhaps? And maybe it's going to get as bad as it was or worse?
Don't just survive, thrive. The Financial Survival Network.
Torque Resources is an exploration company establishing a portfolio of premier copper-gold early-stage projects in Chile. Torque's management and technical teams have a strong track record of raising capital, discovery, and monetization of exploration successes. The company's Margarita copper-gold project is located within the prolific coastal Cordillera Belt in Chile, which hosts some of the world's largest and most profitable copper mines. The Margarita project possesses excellent discovery potential for a major copper discovery due to the strength of the alteration system, large-scale magnetic targets, and the presence of copper oxide mineralization. Drilling is anticipated to begin in Q3 of this year. Torque trades in Canada under TORQ and on the OTC under TRBMF. To learn more, go to torqueresources.com. That's torqueresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
It seems like there's more external factors with the oil market. What is OPEC deciding to do? What happens with the war in Ukraine? Because you were on a trajectory that followed previous recessions where the oil price eventually comes down. And then when you hit a real bottom in the market, then that'd be a time to try to move back in and own some more oil stocks. And we were heading in that path where the price of oil went from over $120 a barrel down to below $80 a barrel. But now with OPEC coming in and cutting their production, it seems to be perpetuating that the price is going to be a little bit higher for longer. But typically in a recession, if you remember in 2008, oil stayed high. It actually peaked in June of 2008, even while the stock market was going down for 8 months. And it was only from June until the end of the year that you saw the price of oil go from $147 a barrel down to $40. And we think that could be a stretch where you see oil weakness, but when you have some external factors like OPEC and Putin, you just don't know exactly how it's going to play out in the interim.
This is very, very true. So energy, commodities in general, food, what are you thinking?
So we still own a few of our energy positions that deliver income in our high income strategy. We like the pipeline businesses in that format. But we cut our exposure significantly there from the beginning of the year just because of this sort of recessionary environment is usually not good for commodities prices. We also cut back on our materials positions for a similar reason, but it's only to sort of just pull back here during this stretch where it pays to be more risk off. The key is you're not seeing enough drilling and push for new supply across the world. So that's really not solving the long-term problem that we have with not enough drilling for oil, not enough natural gas to serve everyone around the world. And so once you see an acceleration in the economy after all of this plays out, we would expect that energy and other commodities businesses would do well again going over the next couple of years.
What about real estate?
Real estate's tough when you've got rates going up as much as they have. You've seen REITs go down by nearly 20% in the public market. Private valuations have held up, but they tend to follow where public valuations go. So we think it might be a difficult stretch for commercial real estate. And for home prices, we actually would start to see some home price decreases. You've already seen a couple of months in a row where the month-over-month prices have started to come down. And we would expect that to continue in the months to come.
Okay, so real estate, but less people being able to afford real estate to own their own home. It's going to be more demand for rentals, isn't it?
That could be. One thing that we've noticed is that people are just not willing to leave their current home if they own one, simply because you're going from maybe you had a 3% mortgage rate, and now you'd have to get nearly a 7% mortgage rate if you needed to move. So you really are not trying to list your home unless you really have to, either for a new job or divorce or something along those lines. So that could lead that younger generations end up staying more in the rental market for longer. But the one catch is the millennial generation, they are forming, the household formation is coming through because they're finally hitting the age where they're getting married and starting to have kids and they want to own a home. What they're typically doing is just moving further to the outskirts of metro areas to find a home that fits their value of what they can afford.
That's interesting. So trends, so people are moving further away because the work environment. What's your take on the hybrid or work from home? Is that going to continue on? Is that a permanent trend, or are we going to see that decline somewhat?
It'll be interesting to see as the labor environment worsens, if companies are able to have more negotiating power to get their existing workers back into the office. But so far, what we're seeing is this sort of hybrid model is likely here to stay. You have people who just do not want to work unless it's a remote job or a hybrid job. And actually, Jim Bianco's done some good work on this, where he pointed out that you've had 3 or 4 major transitions in where work was done over the last 150 years. First, it was people working on the farms, and then that was very arduous work, and they shifted to working in factories, which was relatively easier. Then you had the shift from factories to the office, and now it's office to I want to be able to work from anywhere. And I think right now employees are really trying to stick to that, and companies have not had enough negotiating power to try to get them back in the office 5 days a week. And it's troublesome for companies because they still have to keep the same office space for those couple days a week that the workers do come in. So it's really not any sort of efficiency for them, but they don't have a way to leverage that just yet. So it'll be interesting to see if that changes at all over the next year.
Yes, it will. All right. Well, all of that stuff is intertwined, and particularly for housing, the fleeing of people from northern states with bad weather to southern states, all of that, demographic shifts, such. Interesting. All right. Well, hey, appreciate you coming on, Chance. People want to find you, connect with you on the web. How do you do that?
Yeah, my first suggestion would be to go to our website, oxbowadvisors.com. You can read more about our philosophy, our principles, see some of our latest quarterly updates on how we're seeing the market. And we've also got a pretty robust YouTube channel at Oxbow Advisors if you want to check us on there as well.
All right. And you'll find links to Chance's website and YouTube channel in the show notes to this interview on financialsurvivalnetwork.com. Make sure you sign up for your newsletter. If you got a question for Chance or myself on any topic, just shoot me an email, kl@kerrylutz.com. Chance, Thanks so much for coming on the show. We'll talk to you again soon.
Thanks a lot, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.